Welcome to Ripple Edge, where we cut through the noise and give you the real picture on XRP. Let's get into it. The SEC just quietly dropped one of the most consequential rule changes in the history of retail trading, and most people talking about XRP today completely buried the lead. So let's fix that right now. If you're not subscribed yet, hit that button now. This is exactly the kind of move that reshapes your entire strategy, and you do not want to be the last one to find out. Here's what they won't say on the mainstream channels. The Pattern Day Trader Rule, the PDT rule, has been a wall blocking retail traders from XRP options and short-term plays for decades. The SEC just announced they are eliminating the $25,000 minimum equity requirement, not reducing it, not adjusting it, eliminating it. And when you stack that on top of where the XRP Clarity Act currently sits in Congress, what you're looking at is a genuine structural shift, not hype, not hopium, a structural shift in who gets to play this market and how. Let's break both of these down the right way because the details matter here. The PDT rule has existed since 2001. It was designed to protect retail traders from blowing up their accounts with rapid-fire options trades, which sounds reasonable on the surface. But the practical effect was that anyone without $25,000 sitting liquid in a brokerage account was locked out of day trading options entirely. You could execute 3 round-trip trades in a 5-day window, and on the 4th attempt, your broker would freeze you out. That was the wall. $25,000 to even sit at the table. Now, the number being floated as the replacement threshold is approximately $2,000. The final figure will be confirmed through the FINRA regulatory process, and the effective implementation date is expected to land somewhere between late 2026 and 2028. That timeline matters because it tells you this is not a rumor and it is not a proposal. It passed. The regulatory machinery is now moving to set the execution date, and in financial rulemaking, that distinction is everything. Approved is not the same as proposed. This one is approved. Think about what that actually means for the XRP options market specifically. XRP options are live. They are trading. And right now, the universe of retail participants who can actively day trade those options is artificially compressed by a $25,000 gatekeeping rule that is about to come down. When that threshold drops to around $2,000, you are not talking about a marginal increase in market participants. You are talking about an order of magnitude expansion of who can actively trade in and out of XRP options positions within a single session. That changes liquidity, that changes volume profiles, that changes how institutions read retail sentiment. This is not a small thing. The real play is this. The traders who understand short-term technicals and position sizing before that rule change hits are going to be the ones who benefit when the flood of new participants comes in underprepared. Because here is the honest edge. Most of the new traders who enter the day trading space when that barrier drops are going to lose money early. They will not understand resistance levels. They will not understand how to read Bollinger Band compression, and they will not understand how to manage position size on a volatile asset like XRP. The edge goes to the people who are already sharp before the doors open wide. Now let's talk about XRP price structure because the chart is telling a very specific story right now that you need to understand before you make any move. XRP pushed hard earlier this session, tagging the upper Bollinger Band and nearly touching the 140 level. That sounds bullish on the surface, and it is directionally bullish, but it did not hold. The candle could not close above the 137 resistance zone, which is the critical line that has been acting as a ceiling through multiple tests. Each time price enters the zone between 137 and the 50 exponential moving average at 140, sellers step in and push it back down. That has happened at least 4 times recently, and that repetition tells you something important. There is a concentrated layer of sell pressure sitting in that range that has not been cleared yet. Here's the edge on the chart. The Bollinger Bands are tightening. When you see the upper and lower bands contracting toward each other while price consolidates in a narrow range, that is textbook pre-breakout compression. The 50 EMA is cutting through the upper band, which adds to the tension. The market is coiling. The question is not whether a breakout is coming. The bands virtually guarantee expansion is approaching. The question is direction. What you need to watch for is a daily candle that closes above 138. Not a wick, not an intraday tag, a candle body closing above that level. If you get that close, and then the following session opens and holds above it, that is your confirmation. At that point, the sell wall between 137 and 140 has been absorbed, the 50 EMA flips from resistance to support, and price discovery reopens toward the 160 zone. That is the technical target once the breakout confirms. The consolidation you are watching right now is not weakness. It is pressure building. Every failed attempt to push price back below 130 is telling you that the buyers are defending the floor. The sellers are defending the ceiling. One of those groups is about to run out of ammunition, and the Bollinger Band compression tells you that resolution is close. Now let's cut to the Clarity Act, because this is the layer that changes everything on a longer time horizon, and it is moving faster than most people realize. The XRP Clarity Act is currently in the scheduling phase for a markup vote. The target window is between April 20th and April 30th. If that window gets missed, the fallback goal is to get it done by April 23rd at the latest. What that means in practical terms is that Senate leadership is actively working the vote count right now behind closed doors this week. Senator Tim Scott is not going to schedule the markup vote unless he has confirmed votes to pass it out of committee. That is how he operates. So the moment you see a headline saying the markup vote has been scheduled, that is not just procedural news. That is Scott telling the market he has the votes, and the market will respond to that headline before most retail participants even finish reading the first paragraph. Here is what the Clarity Act actually does, because the name alone does not capture the scope of it. It establishes a clear jurisdictional framework dividing oversight between the SEC and the CFTC for digital assets. It officially codifies the repeal of SAB 121, which was the accounting rule that made it economically hostile for banks to custody crypto, and it creates a defined legal pathway for digital commodities that removes the ambiguity that has kept institutional capital sitting on the sidelines waiting for a green light. That institutional capital is not a small number. It is measured in trillions, and it has been parked because the regulatory picture was too unclear to justify the compliance risk. One complication worth understanding is the Coinbase stablecoin provision, which is creating friction in the negotiation. The bill as currently structured would require Coinbase to give up a portion of its stablecoin yield revenue. Estimates put that at somewhere between 15 and 20% of that revenue stream. That is a real number, and Coinbase is not happy about it. But here is the counter-argument that makes passage more likely than not. The institutional inflows that a post-Clarity Act framework unlocks would generate far more revenue for Coinbase than the stablecoin yield they are being asked to sacrifice. The sector growth alone, the new corporate treasuries, the ETF flows, the banking integrations, all of that runs through infrastructure that Coinbase participates in. It is a short-term sacrifice for a long-term structural gain, and sophisticated operators understand that math even when they push back on it publicly. There is also the geopolitical macro layer sitting underneath all of this that is directly affecting crypto sentiment and oil prices right now. The Strait of Hormuz situation and the US-Iran negotiations are in an active back and forth. The United States asked for a 20-year commitment on uranium enrichment restrictions. Iran countered with 5 years. That gap sounds large, but the fact that Iran is at the table and making a counteroffer is the signal, not the number. Negotiations that produce counteroffers are negotiations that are moving toward resolution. A middle ground settlement in the 10 to 15-year range is a realistic outcome, and if that lands before the U.S. congressional summer recess, which would require resolution by late June, the downstream effect on energy prices is significant. Lower oil prices reduce inflation pressure across the board, transportation, agriculture, manufacturing inputs. That macro shift is directly relevant to crypto because risk appetite in the broader market is highly correlated with energy price stability. When oil comes down and inflation expectations soften, institutional allocators move back up the risk curve. And where does incremental institutional risk capital go in a post-Clarity Act environment with XRP options live and PDT restrictions dropping? You are looking at a convergence of catalysts that individually would each be meaningful and together are compounding. Watch the QQQ as your macro read on whether institutional risk appetite is expanding or contracting. When the major tech index is moving with volume and momentum, it signals that the broader institutional posture is not in defensive mode. A risk-on macro environment is the tailwind that XRP needs to convert its technical breakout from that 137 resistance level into a sustained move toward 160. The setup here is this. You have a regulatory catalyst in the Clarity Act that could trigger a sharp green candle the moment the markup vote is officially scheduled. You have a technical structure in XRP that is coiling for a breakout with 160 as the post-confirmation target, and you have a macro backdrop that is moving toward resolution on both the geopolitical and regulatory fronts in a way that expands the pool of active participants who can trade XRP options. These are not separate stories. They are the same story told through 3 different lenses. The PDT rule change is the structural unlock. The Clarity Act is the institutional green light. The technical setup is the timing signal. All 3 are converging in the same window. That is what the noisemakers are not connecting for you. That is the full picture. That's the edge. Stay sharp. Subscribe so you catch the next one before everyone else does.